Thank you all for joining us today. Please give a nice Detroit welcome to our friends from FreightWaves, who are going to come out here and tell us a little more about the Freight Futures product that will be launching at the end of the month. And we are happy to host them. Benzinga is a financial media company. It specializes in the financial markets, data, market data, and alternative data. If you guys are interested in hearing more, please come find me afterwards. But please give a Detroit welcome to our FreightWaves guests.
Thank you. Thanks, everybody. I'm going to stand up here a little bit so I can make better eye contact with you. And I appreciate the warm, given that it's the end of February, warm in Detroit. Welcome. Let's get this over with right away. My name is George Abernathy. I am the CRO of FreightWaves, and I'm going to duck when I say this, spent much of my life in the Northeast. I'm a massive Bruins fan, so go right ahead and tell me about Hockey Town and all that baloney. Boo, thank you very much back there. So we can talk also about the fact that I have a 5-year-old rescue pup that's named Brady, so you can hate me for that too, okay? Thank you. Thank you in the back. I'm the Chief Revenue Officer for FreightWaves. Thank you to Benzinga for this wonderful location for our roadshow, and wanted to give you an introduction to a couple of my FreightWaves cohorts that'll be talking through our presentation, and then I'll give you a little bit more about my background. So, Tom?
Thank you, George. My name's Tom Mallon. I'm the Vice President of Financial and Trucking Freight Futures Markets. My background is commodities as well as market data. I've ran commodity market data businesses at Thomson Reuters, at Interactive Data, as well as Global View before joining FreightWaves. So thank you very much for coming, and thank you to Benzinga. Addison?
Thanks, Tom. Again, I'm Addison Armstrong. I'm the Executive Director of Futures Products at FreightWaves. I've recently just joined the firm just beginning of February. I came over from JP Morgan, where I was in charge of sales and marketing in North America to our corporate client base who traded and cleared futures and options. I met Craig and the team back in the summer and became very excited about this product. I've been in the commodities markets for over 20 years. I've seen a lot of contracts launch, and I think this one has a great chance of being extremely successful. So we're glad you're here today to hear more about it. And with this, I'm going to hand the mic back to George.
Thank you, Addison. And I'm going to do a little bit of housekeeping. Obviously, it's a very open forum, but we'd ask, if possible, to hold your questions until the end. We'll have my FreightWaves cohorts and the folks from K-Ratio will come up and will be available to answer all of your questions at that point and have a great open dialogue. So, as I mentioned, my name is George Abernathy. I've been with FreightWaves right around the same time frame as Tom has, just about a year and a half now. I've been in the transportation, logistics, both on the asset and the non-asset side, so on the truck side and on the 3PL and 4PL brokerage side for my entire career. I most recently had a 12-year stint over at Transplace. Those of you who are in the industry, you know Transplace as one of the North American industry leaders in the 3PL, 4PL space. When I was at Transplace, my last 6 years there, I was president, and Craig Fuller, the founder and CEO of FreightWaves, was soliciting thoughts from his industry contacts. And if you linked in on our LinkedIn with Craig, you know just how deep his contact folder is. But he was talking to a number of us who had positions where he was wondering what our thoughts would be about freight futures. And this was about 3 years or so ago. And as everybody is very happy to see, that I'm going to say this again, he had me at hello. We were managing $7-8 billion worth of freight. We were managing other people's freight. We were dealing on an annual basis with the challenges of the spot market versus the contract market. And while we're going through the discussion, we'll give you some definitions around that if you're not from within the industry. If I had the ability then to de-risk the portion of, or a significant amount of, those billions of dollars of other people's freight that we were doing, and have there be a much greater opportunity and likelihood that we would be able to deliver consistently. And Transplace was as good, if not better than anybody at doing that. And the freight futures opportunity, the hedging opportunity would have demonstrated an ability for us to be even better at it. So that's why I am as excited as I am and as enthusiastic as I am about what's going to happen on March the 29th when we ring the bell, blow a few truck horns, and have a very significant launch down in Chattanooga of the freight futures market. So let me give a little bit of background as to who and why this is being done. FreightWaves. I'll take a little bit of risk here. How many of you are FreightWaves subscribers? Oh, wow. For those who can't see you on the screen, everybody is raising their hand right now. Good to see. 100% of the people are FreightWaves subscribers. If you're not a FreightWaves subscriber, you should be. It will give you the opportunity to continuously see the remarkable content that we put out on all things that are related to the freight markets as well as the futures markets. And what we've done is we've built this world-class community that provides the opportunity to have the intersection of data and technology to have the impact that it can have today through the ubiquitous nature of the cell phone. My prop is over here charging right now, but guarantee everybody in here's got a smartphone or 2 or 5 within their family. The ubiquitous nature of all of that data that's out there gives us the opportunity to use it, provide transparency within this community, and then go the next step and help to de-risk the market. So I'm going to spend some amount of time up here trying to explain to you the why. The why being, it's an opportunity to empower all parts, everyone across the spectrum in the transportation, in the freight community, shippers, carriers, intermediaries. And we do a definition here early on. When you hear any of us talking about shippers, if you're not within that spectrum, you might think of shippers being something related to those big boats that have containers on them. When we talk about shippers, we're talking about people who are manufacturing and or distributing and needing the services of those trucks that run up and down the road. So those folks who are putting their items, putting their commodities into that. And so today we have the ability with this data that's available to us to make actionable tools, and we'll talk about that now in the next little bit. So as we talk about a futures market, you got to have scale, right? You've got to have scale, and you've got to have a number of other components that it's going to be really obvious to you here in the next 20 or 30 minutes as to just how significant the opportunity is. So when I talk about scale, what are some of the most successful markets and futures contract markets that are out there today? Crude oil with its 400 billion plus. Obviously, the OPEC moment back in '83 drove a lot of what you're even seeing that is manifesting itself today. The hub natural gas and 140 billion or so there from a couple of years ago. And then in power or electricity, which has a lot of similarities to freight movements. Geographic dependencies, a static amount, significant volatilities. So, with electric or power in the $400 billion, you've got 3 of the markets that have demonstrated just how successful these futures contract markets can be. So I just told you how big they were. Let's talk about how big the freight market is. $750 billion is the size of the trucking market. Now, you think about futures when they trade in multiples. So the potential value, the theoretical value of that $750 billion is actually more like nearly $3 trillion. And if you look at the slide there and the representation on the left-hand side of that nearly $750 billion and other liquid trading commodities that are large enough to have scale and be successful are much smaller. Petcoke, refined petroleum, ag, power, as I talked about, chem, fertilizers, and all of these things are significantly smaller. In some cases, factors of 2 or 3 times smaller than what the freight market has available to it. Will there be a comfort factor or an acceptance towards the ability to trade freight futures? It certainly should be something that the folks who actually are moving those goods or manufacturing those goods, because the majority of those physical elements that are being moved, the great majority of them are already being traded. So we've made the estimate that about 84%, and as you can see, including energy, ag, the ones that I've described to you previously, that's what's being moved. Those are the commodities that are being moved. So if I'm already moving those commodities, I'm already one of the folks that is manufacturing or producing those commodities, the ability, it's not a giant leap to say that then the transportation, the freight movement itself, the commodity that is, can be successfully traded. How about what will occur around the freight market and the significance of the impact that the freight market has and freight has in the transportation of goods? Trucking, what we're going to be talking about, trucking makes up the largest portion of the way that goods are transported in the U.S. and grows faster, slightly faster than the GDP. So there's nothing that's showing that there'll be, downstream some, reduction in the need for transportation. Much the contrary. We'll talk about the e-commerce effect, the Amazon effect on things. More things are moving via truck now than they were previously. More, even when you compare it to the growth in GDP. I like to talk about, everybody looks outside and they see railroads go by and they see tons and tons and tons of rail cars go by, and you think that the railroad, that's how stuff's getting moved around. As you saw, railroads are smaller than what's going on in trucks. So let's talk a little bit more about the industry sizing. Transportation costs, I think, would come as something of a surprise to the novice, to those of us inside the industry. We're probably thinking that the 8% of GDP that is made up by transportation costs makes sense. But I think that even for someone who gets it on how large the impact is or how much the impact is and the cost that transportation is, I think it would be surprising to many of us to realize that that's a larger cost of goods sold than energy is in many parts of the economy. So this one, I want this one particularly. Everything I say, I hope these drops of gold are resonating with you, but this one should really be impactful. 40% of the S&P 500, those companies have stated that freight and transportation costs are the largest risk that they have, the most substantial risk to their earnings this year and going forward. If you put that into historical context, and all we have to do is look in the rearview mirror, objects in the rearview mirror are closer than they appear. Look just back into 2018. Many of those S&P 500 companies had significant impacts on their earnings by having their transportation costs further out of their control than Wall Street or even, of course, they would like them to be. You can do an easy search to find a number of the largest retailers, CPG companies, folks who are based just in the Detroit area that have had in 2018 significant 150 basis points in a quarter miss on their transportation spend, dramatically impacting earnings, causing there to be shareholder impact because stock values go down, and even sadly a significant number of folks having to be both in the supply chain transportation sector of their business and across the other parts of the companies, some amount of folks being laid off because of those significant misses. So again, I think that particular comment, I hope, does resonate. So I think I've described well that the scale is certainly there in the freight market, but what else do you need? What are the other things that need to be readily available for there to be a successful futures market? Volatility. If everything is easily predictable and easily going to be budgeted, probably not going to find that much interest level and that much hedging going on. Well, what this FreightWave sonar chart is showing you is this is showing you the DAT van freight. So I'm sure those of you in the industry know DAT. Out in Portland, they are the Platts of our market. Anywhere from 750,000 to 1 million-ish transactions on a daily basis. We'll talk more about them a little bit later on, as they are going to be the index upon which the futures contracts will be settled. But let's just look at their van freight index from LA to Dallas over the last 5 years. If you had the ability to predict all of those ups and downs, you wouldn't be sitting in here, because you would have retired very comfortably now, because your insights would be some that no one else was able to give. Yeah, there is seasonality. Absolutely. There is going to be a produce season in the Southeast. There's going to be produce in Northern California. There's going to be apples and Christmas trees up in the Pacific Northwest. If it was so darn easy and predictable, however, then why do these peaks go as high as they go, and why do the lows go as low as they go? And that's the volatility that we'll talk about later on, how you can go about having that be something that you hedge against. It might be easier for me to list what does not impact freight markets from a volatility perspective, rather than having you think about all of these things. But let's just talk about, a couple of them, because in reality, everything impacts the freight markets. Mother Nature, when Mother Nature decides to do something significant, there's going to be a significant impact to the freight market. The trucks won't be able to run in all likelihood for some amount of time, and then in the immediate aftermath and then the rebuilding process, they will be flooding into that area. Well, given that there's only so many trucks in the market, if you end up taking and having that magnetic pull into wherever the impact was, that means there's going to be less of them available for the rest of the geography. Government regulations. We'll talk a little bit about the electronic logging devices as we sit here on the border with Canada, and how Canada is working its way towards their ELD regulations and compliance. The government regulation, the OPEC moment for the transportation industry was the ELD mandate of December of 2017, with the April enforcement date. That drove significant amounts of volatility into our market, and ongoing as the OPEC moment has driven ongoing impacts into the oil markets, that ELD impact will continues on now, will continue to be even more impactful as Canada and Mexico move in that direction. I won't go through everything. One more that I will highlight, trade balance and policy. If you have the ability to predict what's going to occur in our relations with our trading partners, good for you, because 3 days ago, none of you would have said to me, I think that the summit that they're having in Vietnam is going to end early because they're not going to be able to come to any sort of agreement. Again, if you were able to predict that, well done. Let's go to Vegas together because I want you to help me figure out how to bet. But not being able to have that kind of vision on things, that trade policy imbalance, some of what we saw in the volatility and the run-up in the June timeframe last year was the run-up of bringing imports in and getting them into the country before the trade policy and the tariffs had their impact. So it's certainly a great question, and you probably are thinking to yourself, well, good Lord, if the market's this big and volatility has been this significant, why the heck doesn't it already exist? It's a very reasonable question, and let me tell you why. In the fact that technology needed to exist in order for there to be enough data for us to be able to show and for you to be able to analyze what you should be doing, what you should be considering, what you should be hedging against, the ubiquitousness of the telematics device. And again, mine's sitting right over there. Everybody's got one. That means everybody knows where you are, and all we need to do is provide that data, where you are, what you're doing, what your habits are, and the like, for us to get to a level of much more predictability. So I've got all that data, and if we were just a few years ago, it would be going into somebody's, on-premise server, and there'd be one in this company and another one in that company, and there would be really no capability for them to be able to talk. But now we can interconnect those systems through the cloud and do something with it, do something useful with it, do something effective with it. And last but not least, do that effectively with it, I can bring it down. Not only do I get data from that telematics device, but I can actually use the data now from my telematics device. So why else right now? What are the market forces that make now the right time? I mentioned the ELD mandate, in freight, in the transportation market, our OPEC moment, the ELD mandate and the regulatory impact of the enforcement around that and what it's done to the supply and demand side on the availability of the supply. That domino falls and has an impact on the labor shortage. When we talk about labor shortage, the labor shortage as it relates to how many folks are willing to drive trucks. And as we then add the Amazon impact, the e-commerce impact of everybody in the room, I guarantee you, is thinking to themselves, if I want to order something right now on Amazon Prime, it'll probably be to my house by tomorrow, maybe the day after tomorrow at the latest. Well, that means more stuff getting shipped more quickly is requiring then there be potentially something that's getting from a particular distribution center or warehouse that they have. We're making more miles happen, which is exacerbating that labor shortage, which is then yielding a capacity crunch, which ends up giving you what? Volatility. That's right. And volatility is one of the things you desperately need to make this work, and boy, do we have it in spades. So who is naturally exposed to freight market volatility? But before I answer that question, everybody at FreightWaves who's on the live stream is now saying in concert, no truck will ever show up. For those of you like me who bleed diesel fuel and have a little bit of technology on the side, but bleed diesel fuel, it's going to be conceptually challenging for us to think that about this being a financially settled contract and not, I'm going to basically pre-order some trucks and they'll be bumping into my docks. One more time, Okay, I'm lying. It's probably going to be like 3 or 4 more times. No truck is ever going to show up. Hey, Tom, what did I just say? There you go. See, in FreightWaves, we're actually going to get tattoos of that so that folks can understand what we're saying. It's really important that that's grasped because that'll take you away from the historical thought of how could futures work. That's not going to work. That's not fungible. What we're talking about absolutely is. So let's go back to who's impacted by freight volatility. Trucking companies of scale. Okay, well, there can't be that many of them. No, there's 4,500 of them that have more than $20 million in revenue. Shippers, already defined that for you. The folks who manufacture, who distribute, put the freight into the trucks. Shippers, 20,000 shippers have more than $10 million of freight, of trucking, that they're paying for on an annual basis. And who sits in the middle? By definition, the intermediaries, the folks that are at times acting like a shipper and at times acting like a carrier. The freight brokers, the intermediaries, the 3PLs, the 4PLs, one man's broker is another man's 3PL. There are 1,600 of them with $10 million or more per year. So I've just shown you that in the industry participants, there are and is plenty of participants to make a liquid market. So let's summarize. Let's think about what do you need to build that liquid futures market? A large, volatile market. $750 billion. You saw the volatility in just one example of a lane with a significant lane and the rate volatility that you saw on that. You've got to have a benchmark index. I talked about DAT. DAT is the Platts. That's who the industry trusts, and that's whom this will be settled against. You need to have an exchange and a clearinghouse capability. That's where Nodal comes in. We'll talk more about them here in a little bit. And then you need someone, the evangelizers. You need the folks who are giving the visibility, providing the news, the data to be able to think about this intellectually and in a smart way where you can execute and also provide insights, and that's what FreightWaves does. So putting it into one final perspective, so let's just boil this down. And you're thinking to yourself, yeah, $750 billion Abernathy baloney. There's not really $750 billion out there that's going to trade. All right, let's think about what is the absolute defined and defendable number that should be available and should be considered for this market for hedging as we approach March the 29th. We take and scrub that $750 billion and think about taking out the pieces of this that are not going to be over the road, but preponderantly that difference between contract and spot, where contract freight is what is agreed to. For those of you in the industry, you know that the contract rates are usually only worth about as much as the paper that they're printed on. Everybody goes into their year saying, I'm going to drive up the amount of contract rates. I'm going to be less vulnerable to the spot market. I'm going to cover 90% of my freight with contracted or agreed to in advance rates. And the routing guide falls apart sometime in February or March, and we're out there in the spot market where the volatility happens, where you have less control. You lose control over what you're going to be spending on your freight or on your transportation. And so boil that all down to just the spot market, all right? Take out all the contract to the spot market. You've got about 40 billion miles of the spot market using about 10 to 15% of the total market, which at 1,000-mile increments that Tom will describe how these contracts are going to be set up, That's approximately 40 million futures contracts. That is the potential size of this market. And again, we talked about the fact that they have and will be trading in a multiple, so that 40 million contracts will trade at a much higher number than that. So you've heard a lot from me. I'm going to turn it over to Tom so he can talk about the Nodal exchange and the way that this will be cleared. Or what are you going to do? Are we going somewhere else? Oh, Tom's not going to talk about it. Addison is. So, Addison, all yours.
Thanks. Thank you, George. Why isn't this moving? Okay, where are we going here? Where is the mouse? All right, let's go back to this guy. Okay, so as was mentioned, I'm tall, so I'm going to come down. Our partner in terms of an exchange provider and a clearinghouse provider is the Nodal exchange. The Nodal exchange will provide price, credit, and liquidity risk management for those who trade in our markets. The Nodal exchange was founded in 2009 by industry participants in the electricity market. It's largely, most of its clients, well, it has many clients in the financial markets, but the founders were all basically electric utilities who needed to hedge their risk at a more micro level than was available from the contracts provided by the CME and the Intercontinental Exchange, and that they wanted to hedge down at a much more local level than at the big hubs like PJM or ERCOT or NiSource or some of the other ones that are fairly robust contracts on those other exchanges. So again, founded by industry participants, owned ultimately by Deutsche Börse, which is the large German exchange company. So great technology backbone, great capital backbone, lots of experience clearing new markets. One of the big markets that Deutsche Börse also owns is the EEX, the European Energy Exchange, where they have begun to clear such alternative contracts as carbon credits and other environmental products. So when we think about new futures contract launches, certainly trucking freight futures would fall into what we would call an alternative product, one that's not a little bit outside the mainstream. So again, lots of experience with our partner at Nodal in doing that. Nodal Clear is the clearinghouse. They will provide the financial risk management, much like the clearinghouses associated with the CME and ICE would do for those who are in the room and very familiar with trading and clearing futures. They have a little bit of a different margining system. They use what's called portfolio margining, not span that is used on ICE and CME. Again, when you have a clearing account, for those, how many people here are familiar with the use of futures? Show of hands. So about half and half. Okay, so for those who are not, I'll just go through quickly. When you have a futures account, when you make a trade, you have to deposit basically a performance bond. It's called initial margin. And that initial margin is set by the exchange. It's usually, we haven't set ours yet, but it's usually somewhere around 10% of the notional value of the contract. So if you think about our contract, and I'm skipping ahead a little bit because we haven't told you about the specs, but it's 1,000 miles, and if we say right now the national index is $1.50 a mile, so the underlying value of the contract is going to be $1,500. Therefore, in order to trade that contract and maintain that position, you would have to deposit $150 with your clearing firm. So that position then is marked to market on a daily basis. If your position goes in your favor, in other words, if the $1.50 becomes $1.60, you're 10 cents to the good, you're fine. You don't have to. You have a credit at your clearing firm. You don't have to do anything. If the value of the position goes down, one of two things can happen. You can trade out of it if you don't want it anymore, if you think you've placed your hedge the wrong way, or you post more margin. You get what's called a margin call. You have to deposit that money 1 day after after the change in value, or else the clearinghouse will close you out. So those are just some of the nuts and bolts of trading in the futures markets. So on the Nodal exchange, there are 12 clearing firms currently that will clear this product. They are talking to 3 others, 3 independent ones not affiliated with big banks. So again, there's 2 steps in being able to trade our market. One, you have to become a member of the Nodal exchange. Sounds onerous. It's not. First of all, there's no cost to becoming a member of the Nodal exchange. But it's really it's a process they have because it's a participant-to-participant market. So they have a responsibility to know their customer because you are a participant on their exchange. So it's a form you fill out, and then there's some KYC that has to be done associated with you becoming a Nodal member. And then you also have to have a clearing account at one of these firms. There are, as you can see, there's some large, frontline banks on this list, and then there's independent clearing firms such as ADM Investor Services, ED&F Man, which is an old futures broker, started as a sugar broker, over 150 years ago. A lot of experience in these. All these firms have great experience clearing futures. So again, you have to have an account with them. If you don't, if you want to move forward and trade this product, we can help you, direct you to a firm that would be best suited for the kind of business that you're going to do. So you've registered with the Nodal exchange, you've set up your clearing account, now you want to trade. Well, how do you do that? So there are several different ways. First of all, I want to point out that Nodal's matching engine, which shows the bid and offer and then shows when trades are concluded, is backed by something called T7, which is a product of Deutsche Börse. Very robust. Obviously, they're clearing many different exchanges or executing trades on many exchanges using this platform. So as a customer and someone who wants to trade this product, you can go directly into the Nodal platform and trade there, and the trades will be cleared into your clearing account at your clearing firm. There's also in the futures market something known as block trades, something more than one contract. In some markets, a block trade is 50 lots. We think, and it hasn't been set yet, but we think block size in this market will be 10 contracts. And what that allows, when you trade as a block, you can call a voice broker and have them execute the trade on your behalf, so you never have to touch the screen. They do the trade, and then they put it into clearing at the exchange and alert your clearing firm that trade will be coming from the exchange into your account. And then finally, through our Sonar platform, again, one of the products that FreightWaves has, very robust data and analytics platform, all centered around the freight market. If you're a subscriber to Sonar, there will be a way for you to access the market directly from the Sonar platform. It'll be a very simplified screen, so you wouldn't be able to go in there and trade sugar or coffee or cocoa, for instance. It will just direct you to our trucking freight futures product. So 3 or 4 different ways to access the market. For more sophisticated financial players, you will be able to, if this is your style of trading, you will be able to write an API to the Nodal T7 matching engine, access the market that way, or if you're using a product like TT or Bloomberg EMSX, they will also be available. Our product will also be available to trade through those venues. I think that's all I have to talk about, and with that, I'll turn it over to Tom, who will take you through the highlights of the contract. Thank you.
Thank you, Addison. My name's Tom Allen, and I will take you through the highlights of the trucking freight futures contracts. First, before we start, I just want to get a sense. How many in the audience are shippers? If I can see some hands. Okay. How about carriers? Okay, about 5 or 6. And intermediaries? And how about others? Okay, very good. Thank you. And then just one other thing, too. You know, George made the point about the contracts being financially settled. So, what will never, ever happen with these futures contracts?
Truck will never show up.
Thank you. So a bit about the futures contracts. So George mentioned in his slides, we've partnered with the Nodal exchange as well as DAT to create a network of futures contracts which we believe are representative and will provide a risk management tool that will enable hedging to take place on freight being moved throughout the network of lanes in the United States. And in working with DAT, and as George alluded to, they are the premier price assessor for the freight industry, and Nodal. We came up with, a boiled down network. And DAT on any given day assess about 18,000 lane pairs or origin destination pairs. And from those 18,000 lanes, we boiled down the network to be 6 cities, so key transportation hubs, and 7 different lanes. And those lanes include LA to Seattle, Seattle back to LA, and then the average of those two would make a West Coast basket. In the South, we've got LA to Dallas, Dallas back to LA, and the average of those 2 lane pairs would be the South basket. And then in the East, we've got the triangle from Chicago to Atlanta, Atlanta to Philadelphia, Philadelphia back to Chicago. And the average of those 3 lanes would comprise an Eastern basket, and then a national basket is derived from the average of the 3 regionals. So we've identified through our partnership with Nodal and DAT 7 different lanes which will trade, 3 regional baskets, and a national average. So up to 11 futures contracts will be listed on the Nodal screen on March 29th of this year. A little bit more about the rationale for the selection of these lanes. On these lanes, we have estimated that about 22% of all dry van freight is moved on these lanes, with a correlation of about 83% nationally. So a very representative and liquid set of lanes. There are thousands of loads being moved on any given day along these lanes, and it correlates very well to the national movement of freight. So that's the rationale behind the network as we have selected it. A bit about the contract specs themselves. So I've mentioned the rationale behind the 7 lanes, the regional averages, and the national average. And there are pamphlets which you guys, I think, all have picked up coming in that actually identify the zip codes that comprise each one of the cities. So please do have a look at that. The contracts themselves, they are cash settled, and as we keep repeating, a truck will never, ever, ever show up, nor will any goods on a truck ever show up. They are financially settled instruments to be used for hedging your physical exposure, in trucking. They're monthly contracts. They will be able to be traded out 16 months forward. So if we were to launch a contract starting tomorrow, which is March 1st, the March would be listed, and you'd be able to trade out 16 months forward. We settle these contracts on a daily basis, so daily settlement will be done on the Nodal exchange based on trading, based on bids and asks, based on input from industry participants to come up with an end-of-day settlement price, which would then be used to mark the contracts to market. The type of contract, these are dry van line haul rate contracts, so there are no accessorial charges or diesel fuel charges taken into account. These are the actual line haul rates, what it takes to move a dry van along any one of these lanes. The size of the contracts are 1,000 miles, as George alluded to, and they are priced in dollars and cents per miles. So that's a bit about the contract specifications themselves. A little bit more about DAT. We have partnered with DAT because they're the best, and they are the largest in terms of assessing the market. Last year, they built, they assessed freight worth about $60 billion, and that was comprised over about 256 million electronic transmissions into their databases. So, they assess the market quite well. It's very broad, very representative, which is why we've selected them to be the ultimate settlement mechanism for these contracts. And what I want to do now is just give you a quick a demo of a trade simulator, just to give you a flavor for how a trade could be executed, how a hedge could be executed using these trucking freight futures. So what I'm going to do is I am going to go into our Sonar platform. And what you see here is a version of a freight simulator which we've built into our Sonar platform. This is not the CQG platform that real trading will take place on. This is just a simulator. We ultimately, as Addison alluded to, will build into FreightWaves the capability to go straight to the CQG instance for Nodal and execute trucking freight futures. So what we have here is the simulator. The top part is where the FCM, who you have to have a business relationship with, will set up your limits and your account to be able to trade. So they'll set up your account, they'll set up your position limit. On a daily basis, when you're trading, you'll be able to see any profit or loss associated with any trading. The middle part of the screen is where I would actually select a futures contract that I'd want to trade. So in this scenario, what I've done is I've selected the East Van lane as assessed by DAT. We've set up, for example purposes, the 3 regional and the national average. And down at the bottom here would be all of my trade activity, whether it be orders that I've put into the market, or it'd be my positions, those contracts that actually have been executed. Right now, I have no open positions because I haven't done any trading yet. And then on the left side here is actual real data that comes from our Sonar platform. So right now, I am pulling up the DAT Van Freight Rate Index for the East. And as you can see, quite volatile. And you can see since the beginning of the year, there's been quite a drop-off in terms of rates. So what I'm going to do is take the perspective of a shipper in this scenario, and just looking at the data on my FreightWaves Sonar, I see rates have come down, but they're beginning to rise again. So as a shipper, I'm naturally short capacity, so my fear is that rates are going to rise. And so to protect myself, and I'm looking at the rates right now, they seem reasonable, I'm going to try to lock in a rate. So in order to do so, I'm going to go to my, my order book. I'm going to select a contract that I want to hedge. And in this scenario, let's say I've got 20,000 miles worth of freight that's going to be needed to be moved during the month of March. And I'm going to want to protect against a rise in rates. So in this scenario, what I'm going to do is I'm going to want to buy 20,000 miles worth of futures contracts. So given the fact that the lot size is 1,000 miles, I would want to buy 20 futures contracts. So I enter in my quantity, select the buy button, and I put my order into the market, and it's been filled. If you look up at the upper right-hand corner, I get a fill confirmation back in the right-hand corner, and down in the bottom part, I have I see my position that I've bought 20 futures contracts. I paid $1.682 for those futures contracts, and it says that I'm long. Long means that I've bought futures contract. That is my position. as my freight is contracted and begins to move, I'm going to want to unwind my hedge position. So I'm going to go back into the futures market. I want to place an order. I'm going to want to sell now 20,000 miles worth of futures contracts, which is 20 contracts, and I'm going to sell. I'll get a confirmation again up in the right-hand corner. You'll notice that in my position, I have no more position, which means I'm flat and I've unwound my futures position. So that's just a quick example of how, through Sonar, orders can be placed into the market, and just a use case for how a shipper would want to protect themselves in a rising rate environment. So with that, I'm going to turn it over to Kyle Lintner from K-Ratio, and he's going to walk you through some additional use cases.
Hello, everyone. My name is Kyle Littner. I am a principal at a firm called K-Ratio. We're an NFA member firm, CFTC registered CTA. It just means we're legally allowed to provide advice and risk management related to futures trading accounts. With that, I thought we'd dive into how some of this stuff looks. Specifically, we're talking about missed earnings. 2018, 40% of the S&P 500 companies cited transportation costs as the primary reason they did not meet their earnings. That is a very large number for a lot of companies. Specifically, if you are a publicly traded company, talking about a lower stock value, lower investor confidence. If you're a privately held company, this lowers your annual EBITDA, compounded by your industry multiple. All of this stuff carries forward. It isn't quarterly, it isn't just yearly. This stuff goes for 3, 4, 5 years out. This lowers your enterprise value. It's estimated that 5 to 14% cost of goods sold is transportation expense. That is a very large amount subject to a lot of volatility that until March 29th has no tool to hedge that risk. This is simply put, taking a variable cost and making it a fixed cost. We're looking at locking in rates to ship our goods going forward. 2018, year over year, we saw a 30% increase in freight rates. Contained within that 30% were multiple instances of more than 60% swings in volatility. That is an enormous amount of risk to leave unhedged. Visually speaking, if you are a shipper, and in this instance, this is the 2018 DAT National Average, one of the traded eligible products, we see the peak in summer. We see where we currently stand now in green. This is the lowest rates since 2017. This is the opportune time to lock in rates if you are a shipper moving forward. You can now plan your costs and know what they will be and execute your business with your freight spend locked in. Conversely, for the carrier, same idea, same fiduciary responsibility, except now we're talking about revenues and not costs. We're taking a variable revenue and making it a fixed revenue. This allows us to know what our trucks are going to be run at. This allows us to lock in what our trucks are going to be run at. We go back to the same chart, take it from the different perspective. We see the peak again, June, July, back when everybody thought we were going to $3 and beyond, and everybody was wrong. Had this tool been around, we would have been able to lock in rates and now operate our business at those rates. You had plans to expand your business, you could do it with a revenue number based on 209, not down here at $1.40. Since January 1st alone, we are down more than 20% in rates. If you were that carrier that locked in these rates, if this was around, you're sitting a lot better. This is where it gets kind of fun in my eyes. This is like my own personal take on everything. For the 3PL, fixed operational revenue, fixed carrier expenses. So we're talking about taking a stance like a carrier and taking a stance like a shipper because you are the intermediary between the two. If we look at it, it is long and short at the same time. I understand it makes little sense at the very beginning. We're talking about something conceivably delta neutral, but it isn't. We're going to take it in two different instruments. The first, the easiest to get at, the carrier side of it. We take a revenue hedge on your estimated revenue, just like a carrier would do, a short position. In this instance, we could do it again on the national average. Short at high elevated rates, lock in our expected revenue moving forward. The twist to this is the carrier expense. If you are a 3PL, with almost near certainty, you are booking your loads, even your contract loads, in the spot market. That is spot market exposure, spot market volatility. You're naked and you're unhedged in that market. If you take this side of it, take your book of business, apply the correlations to the lanes that are being offered, lock in from a long position, you can now honor your commitments better to your customers. You can maintain primary status and commit to 100% of loads, knowing that you don't care where rates go because you don't care about the price you book that truck at. You're going to offset it with your hedges in the futures markets. This is not just an advantage above your competitors for this year. This furthers your business going forward because you can now get a greater market share of that shipment, knowing that you never have to walk away from your rates and you never have to tell your shipper, we don't want it, sorry, it has to go to spot. I understand some of these concepts are a little difficult to grab at first. I will be around post-show. You can also visit us on our website, kratio.com. Aside from just myself, we have an entire team compiled of NASA engineers, rocket scientists, you name it. Personally, I have over 20 years experience in the futures market, the last 15 of which trading my own accounts in stocks, bonds, futures, options, currencies. I've been a member of the Chicago Board of Trade since 2006. With that behind us and out of the way, I'd like to open it up to Q&A and invite all the speakers back up. Sorry, we have a mic?
Yeah, we've got a microphone out in the audience. So, given that Kyle has all the rocket scientists, and I'm certainly not one of them, Phil, right here.
Thank you for the presentation. To be able to participate in this futures market, you don't have to be in the transportation industry at all, right? You can be anyone. So it is basically, I mean, you are putting this in the context of transportation, but it's just like a stock that you can invest.
It's not. It's a futures contract.
Yeah, I know.
Right,
Yeah.
right. So yes, it's just like if any good futures market has both native hedgers that come from the industry and speculators, right? Of course, we want our market to be as successful as possible, so we want all of those types of traders in our marketplace, and we have actually not just there are people in the room today and every one of our road shows who came from the speculative community, particularly in places like New York and Chicago, and we have an outreach to that part of the trading world, and we are hopeful that day one or shortly thereafter we'll have financial market makers on the platform who are ready to stand and make a two-way market.
So just I don't know the other future markets, but since you are saying that there will be no trucks showing up, right? So it has nothing to do with the actual transportation movements. It is simply an instrument to invest and bet financial investment.
It's financially settled, which means it's so there are contracts in the futures markets that are physically settled, where if you don't trade out of the contract before it expires, you better have the ability to take that grain or deliver that grain. But there are other well-established contracts in the futures market that are cash settled, such as ours. So actually, in Tom's example, where he trades out of his position, you actually don't have to do that with our contract. You could just let it settle into cash, and you don't actually have to execute a trade to get out of it.
Okay, thank you.
Do you guys anticipate this leading to other types of equipment, reefers, step decks, flatbeds, or is it going to be just vans?
Yeah, the answer to the question is yes. There are lots of different instruments that could be listed as we move forward, but in order to get a contract to launch, we started with dry van just because it's the biggest for us. But there are other instruments, as you say, reefer, flatbed, and others that ultimately could be listed, in addition to options on these contracts, shorter dated contracts. So we will listen to whatever the marketplace tells us to list, and we'll go from there. But on March 29th, it's the dry van.
I got you.
Yes.
Okay, what about more potential lanes? Is that something as well?
Yeah, potentially. I mean, we looked, as I say, DAT assesses about 18,000 or so origin destination pairs on a daily basis, and we looked at a lot of different lanes. and some of the other lanes which we considered really didn't change the metrics, about the number of the actual freight that's actually moved, nor did it change the correlation. So we went with these because they're representative, but if our customers say add additional lanes, we certainly would look to do so.
Okay, thank you.
So if I were a 3PL company and I have given a quote of $1,500 to a customer for Atlanta to Chicago, and at the time of the shipment it cost me $600 or $1,600, is it saying that the market, because I have hedged it, will pay me back that loss that I've got from the $100 that I've paid the carrier? Like, how does that balance out?
Without getting into complete specifics on it, and it would be dependent on the timing of all of it, but in theory what you would do is price that to your customer. I wouldn't advise on taking the position prior to winning that bid, but if it was something where you had a little bit of leeway as to when that was going to happen, any gains or losses in the futures market are meant to be offset by whatever your underlying business is. So what your quote would be, and if you sent your load at $1,600 in your example and locked in your rates in the futures market at whatever that price may be, if the rates when the time came due for that load to be moved went higher and you owed them a different price, or you went to source your capacity and they wanted more, you would be insulated from that price movement because you hedged it in the futures market. So even though you lost theoretically money in the real world, handing the carrier more money to move the load, those would have been offset by the corresponding move upward in the futures market, and the goal is to try and get that close enough to a 1-to-1.
Can you explain a little bit more on the 3PL side, how there was you were long and short there? Can you just dive into that a little bit more?
Right, so we'd have to take it in different products. And in my example, what I would recommend is the short to go on a macro setting of the DAT national average or one of the regionals. The long positions would be lane specific. So in that instance, it's LA to Dallas. That doesn't have to be LA to Dallas. It can be any one of the 7 lanes. But whatever corresponds best to your book of business or those loads or your contract business with someone, you hedge those specific loads and those shipments on the 7 independent lanes. You take your short revenue hedge on one of the averages, be it regional or national. That way you're protected from an overall drop in rates to your bottom line, because as a 3PL you probably operate better on higher margins, on higher revenues. When the rates come down, those get compressed, and we're also taking it out of a smaller pie. For the lane specific, we're trying to insulate from the carrier expense when you go to source capacity and rates move higher. In the same instance as the other gentleman that asked, if you book your load at $1,600 and then the rates have moved higher in June and we're now up to $1,800, that move would also happen in the futures market. So even though you went to that carrier in June and you had to pay him $1,800 to move the load that you booked at $1,600, the goal is that you hedged your futures prior to that at $1,500.
Thank you.
Sure.
One question right here first. Are the index settlements going to be Asian swapped or bullet swapped?
The settlements will all be the non-weighted simple average of that calendar month's business. So for April, we will have 30 days of prices. We'll have the average of that price. That will be final settlement.
So you won't have perfect alignment to the physical market then?
It is the DAT numbers that are provided for that lane. It won't be the futures market. It will be the underlying or cash market. The goal is complete convergence.
How will you mark the forward curve for the futures?
It depends on where your bids and offers are. I don't know what it's going to look like on day one. I don't think anyone does. But there will be measures in place to try and take whatever that spread between the bid and the offer is and the traded activity and lay it out as to what the perceived value is. Because, yes, we don't know what something in August is going to be priced at now. We have to take it at what the market is implying.
Just as a follow-up to that, there is a published methodology to the way the contracts will be settled and the way the market will be run. This was produced by DAT and Nodal and was filed with the CFTC. It's a public document. If you're interested in the specifics of the methodology, let us know. We'd be happy to get that to you. Again, it's a highly regulated business. It's government regulated. Every participant in this market, whether as a trader or as a vendor, has to be registered with the NFA. The contracts are all registered with the CFTC. So again, it's very public what the methodology is, and we're happy to share it with you.
Can you speak to how the futures would be taxed, since it's a little different than a normal stock trade?
I am not an accountant. I don't want to go on record saying that I am. They are taxed differently. The capital gains are not the same. We have a ratio of it that is determined as long-term income, and there is some that is considered short-term income. Again, I don't want to misspeak or overstate my bounds, so I would advise contacting a registered CPA. It would be the same as any other futures market, though.
How does DAT collect the revenue for amounts for the trucking part? Is that from the shippers or from the carriers?
Both, and brokers.
Yeah.
The anonymous data submissions, and there are filters in place to assure that there is a certain amount to make the numbers submitted justified. I believe no one can be more than 49%. Right. Yeah. It must be at least 8 reports, or 8 different companies with 3 different reports on that lane, so there can't be the one-off instance of something that's erroneous and not true of what that price should be.
One trade won't set the market.
Yeah.
So there's normalizing for like fuel, because a lot of brokers just do like flat rates and don't have.
Yeah, they're backing out fuel, accessorial charges, so that's not included in the line haul rate. It's the line haul rate that they're collecting. Yep. Yes. And to your point too, I mean, the collection methodology, it's all electronic. So, it's not being phoned in, or it's not something that is indicative. These are actual loads that have been picked up and moved and submitted to DAT electronically.
Nothing off the load.
Yeah, Kyle just made that point. For those of you who know DAT really well and understand their load board and the like, and where but this is not pulled from the load board. So these are actual transactions, actual loads that have been moved. You've used your quota. That's good.
Where's the fuel calculation coming from?
The fuel's being backed out, so
I understand. Right? I understand that part, but if you're a DAT user, you're seeing
it's
all in rates all the time.
It's the DOE that all of the surcharges are based against.
Okay, on a national average basis or a regional basis?
It depends on which of the contracts you're talking about.
Okay.
All right.
So if it's a national contract, they're using national
DOE,
fuel.
right.
Regional contract, they're using regional fuel.
Yep.
Okay.
So I'm always interested in new derivative instruments. So kudos to your team for introducing a new instrument to the market. Clearly, there seems to be a need. I'm trying to understand what are the market participants you anticipate being in the market? That's one question. The second question is, how does FreightWaves? What is the role of FreightWaves in this thing?
I'll take both of those. I was going to take one and hand off two, but I'll take both. Let me the answer on who are the participants going to be. Our expectation, if you think across the spectrum of the industry participants on the shipper side, at first, the likelihood that those shippers who are already trading in some sort of fashion around a commodity or in a hedging or in a futures contract are the likeliest to have, and we've already got significant amounts of them in the process of or already signed up to participate. But with that being said, that their Treasury Department has already been doing this, et cetera, 2018 was, as Kyle described, there were certain time frames where you were looking at 30, 40, 50% or more of an impact on the spot market that was hitting every shipper. So even those, we've had many conversations with those that may not be trading around other commodities. Excuse me. They're not going out and having to source a physical commodity like a corn syrup, which Anheuser-Busch obviously isn't doing, but others that might be. That is where we see 2018 having such an impact, and where the shipper's perspective will come from. And as we've talked about, the protecting of costs versus the protecting of your margins or your revenues, the protection on the cost side of that is impactful for any number of those S&P 500 folks who had really tough quarterly earnings calls when they were dealing with why are your transportation costs out of control. And stay on the spectrum though, and you think about on the carrier side, there are any number of carriers, as Kyle described. Where are we sitting right now from a rate perspective? The carriers out there, have a pretty good perspective of what's going on in the marketplace. And if they're feeling that there's going to be something, happening around rates going down, they can obviously try to protect themselves and protect all those assets that they've got to keep paying for. You're paying for it whether it's moving or not. So I've got to try to protect myself there. And then the intermediary has got to be thinking in the way that Kyle described it. I think it's a fabulous way of looking at it, and I agree with you. Sometimes it's hard for me to get the how am I going to be long and how am I going to be short, and I think that Kyle describes it very well on what should be macro versus what should be lane-based. But that's where the intermediaries, and as we've done the roadshow, and this is roadshow 8, guys, I think, or something like that, and by far our best one, or by far our best crowd. But we've seen the wide spectrum. There have been shippers in the room. There have been intermediaries in the room. There have been carriers in the room, financial folks in the room, folks who have seen this new instrument and just have an interest level in it. But importantly, everybody on the spectrum of industry participants, everybody is showing interest. And from a volatility perspective, we may not be paying 60% more in the spot market right now. We're paying 20% less or something like that. Freight waves, our responsibility in this is the marketing, is the evangelization. We also have product in the, we saw some screens there in our sonar product, which will be one of the mechanisms that will be capable of conducting the trades on that. So that evangelization comes from the fact that it was a FreightWaves idea. It was a Craig Fuller idea that has manifested itself into what it's doing now, and you need to be able to have the credibility that we think we bring now with so much of what we do in content and the folks that work for us, the tribal knowledge that we've got. You need to have that within the industry, and these guys can speak to how that has worked itself out in other futures markets. That's the role that FreightWaves plays.
Will open interest be visible on the Nodal exchange 16 months out?
You saw all their heads go up, right? You could hear the rattle from back there, I'm sure. So the answer is yes.
And then the other question is, will this derivative qualify for hedge accounting treatment?
Yes, 100%. For all intents and purposes, this is no different than any other future.
Except it's cooler.
A lot cooler. And much bigger in scope.
And much bigger in scope. Much bigger, much more volatile.
Much more volatile. Much more fun to trade.
I know Trump will show up. Does anybody have that?
Cash settled, people.
I've seen Chad present the sonar system on FreightWaves and all that. So is that going to?
FreightWaves now?
Yeah.
Hey, okay.
So is that something that is going to be a subscription base, or is that going to be
It's FreightWaves now?
Yeah, like to be able to see the technology in the sonar. Like I saw the presentation that he's made on there, and they're really good. So is that going to be available to the public?
So FreightWaves Now will continue. Don't be surprised if we expand the amount of visibility that you've got from a video perspective with FreightWaves, and the remarkable amount of content, the remarkable amount of output that we provide. But FreightWaves Now will continue on, and Sonar, as it continues to evolve and bring in data sets, that's really what FreightWaves Now is attempting to give you on a daily basis, which is what's going on in the market, right? And not giving anything near specific suggestions or recommendations on what I should be doing within a particular financial market, but it is demonstrating, and as we bring in new data sets, so if you watch FreightWaves Now every day like I do, you see that there is the what's going on in the market, what's the impact to road conditions, what's going on in particular markets today, and looking at what might be occurring tomorrow. Certainly not looking 16 months out like that, but also as we continue to add those data sets into Sonar, producing those in the indices that we are building, and our merry band of data scientists are building, like unlike anyone else has ever done within the industry. That's what FreightWaves Now is doing.
But I think to your point, Sonar will continue to be a subscription-based product. The FreightWaves Now and the FreightWaves website will be, free content, but the Sonar product with all of its data and analytics will be a subscription-based product. Yes. Well, if there's no other questions, I would just like to wrap up this portion of the event by saying a big thank you to our hosts, Benzinga. Thank you very much. We really appreciate the opportunity to come up to Motor City and talk about what we're doing in the futures markets. We do have a networking event right here immediately after this. We'll all be around to answer any other questions that you have. We also, before you get out of your seats, I think a lot of you left your business cards at the front. We have a little bit of a raffle here for a couple of goodies. So I'll turn it over to Tom.
There are two goodies. Whoever gets the first drawing, you get first choice of goodies, and then number two gets number two, and you get slices of
Sure.
Yeah, well, it's a financial settlement. No truck will show up.
First choice, Gary Short, Go-To Transport, Inc. All right. There you go. And so the portable charger goes to James Applegate from Landstar. James Applegate. All right, great. Yeah, good geography there. All right, well, again, thank you all for coming out. We'll all be around to answer any questions or just network, and we really appreciate you coming here today. Thanks very much.